There is a pretty fundamental rule in global finance, and it's basically when the world gets scary, money gets scared.
Right, exactly. Risk off.
Yeah, risk off. And if you look at the geopolitical landscape today, I mean, it is Tuesday, April 14th, 2026. Over just the last 48 hours, we have watched these diplomatic talks between the U.S. and Iran just completely collapse.
Utterly fall apart.
Right. And the Strait of Hormuz, which is, one of the most critical oil choke points on the planet, is under renewed and highly credible threats of closure.
Which is terrifying for the markets.
It is. By all traditional textbook logic, risk assets should be an absolute free fall right now. Investors should be fleeing to the safety of government bonds, hoarding cash, basically stuffing it under mattresses.
Yeah, the risk-off alarm bells are deafening across traditional trading desks right now.
Totally.
When you have overlapping macroeconomic shocks like, energy supply threats and massive diplomatic breakdowns, institutional capital historically just runs for the hills. You expect panic selling.
And yet, if you pull up the crypto market charts today, it is completely ignoring gravity.
It's wild.
It isn't just stubbornly holding its ground. It is actively pushing higher. It is a glaring paradox, We're looking at a market that seems totally disconnected from the reality of global panic.
Disconnected is putting it mildly, yeah.
Right. So we've got a stack of fresh market newsletters, regulatory updates, and the latest from top industry analysts. And our mission today is to figure out why. Okay, let's unpack this. Because to understand why digital assets are pumping while the rest of the world just holds its breath, we have to look away from the Middle East for a second.
Right.
We have to focus on a single massive corporate anomaly happening right under everyone's noses.
Yeah. It's entirely counterintuitive until you look at the mechanics of what is actually playing out with Michael Saylor's company, Strategy.
Okay, yeah.
And specifically, its trading instrument, STRC. People are dubbing this the Saylor effect.
The Saylor effect.
Exactly. Through STRC, Strategy has acquired over $1 billion worth of Bitcoin in just the past week alone.
Wow.
Yeah, we are seeing STRC shatter its own historical trading volume records.
I mean, $1 billion in 7 days is a staggering figure. But I have to admit, I struggle to see how a single corporate buying spree just completely overrides global macroeconomic panic.
It seems like it shouldn't, right?
Yeah. What is driving that much capital into STRC right at this specific moment?
It all comes down to a calendar date, honestly. Tomorrow, April 15th, is the ex-dividend date for STRC.
Wait, a dividend date? A dividend date is driving a $1 billion market anomaly.
It sounds crazy, but yes.
How does that actually work in practice? Like, why the rush?
So think of the ex-dividend date as a strict cutoff line drawn in the sand by a company. If you purchase the stock before the market closes today, you are legally entitled to receive the company's next scheduled dividend payment.
Got it.
But if you buy the stock tomorrow, on the actual ex-dividend date or any day after, you miss out. The person who sold you the shares gets to keep that upcoming payment.
Oh, I see.
And right now, STRC is offering a monthly dividend of roughly 96 cents per share.
Wait, 96 cents? Which honestly sounds like pocket change.
Right.
I mean, 96 cents doesn't sound like the kind of money that shifts global markets and defies geopolitics.
Well, it sounds small to a retail investor who's just buying 10 shares. But you have to scale it up to the institutional level. If a massive hedge fund buys 1 million shares, that is a guaranteed return of nearly $1 million for simply holding an asset across a 24-hour threshold.
Wow. Okay, that makes sense.
Right. In a volatile, scary macro environment like the one you just described, a guaranteed fixed yield is like an oasis in the desert.
So it's like an arbitrage play.
Exactly.
It reminds me of, it's like someone overpaying for a cow at an auction today, strictly because they have a guaranteed buyer who will pay a massive premium for tomorrow's gallon of milk.
That's a great way to look at it.
You overpay for the cow, you collect the milk money tomorrow, but then on Wednesday, you are stuck holding an overpriced cow and the buyer is gone.
What's fascinating here is the structural vulnerability that your cow analogy perfectly illustrates.
Yeah.
This $1 billion buy wall that is artificially holding up the crypto market right now, it's not necessarily built on organic, long-term belief in Bitcoin as a safe haven.
Right. It's just greed.
Yeah, it is a highly localized, mechanics-driven frenzy to capture yield. And here is the mechanism that creates the feedback loop.
Okay, let's hear it.
Strategy doesn't just hold that incoming capital. They take the billions raised through these equity-like instruments and immediately convert it into spot Bitcoin exposure.
Oh, so they're actively pumping it.
Yes, that buying pressure drives the price of Bitcoin up, which then drives the value of STRC up, which of course attracts more dividend chasers.
But the music has to stop, right? I mean, once tomorrow's deadline passes, that incentive vanishes completely.
Yeah, the inflows are highly likely to drop off an absolute cliff. And when that capital fire hose gets shut off, the market loses its primary engine of momentum.
So it could crash.
You could suddenly see a massive pillar of support yanked right out from under Bitcoin's price, leaving it highly exposed to those exact global macro fears it has been ignoring all week.
So the current price action is essentially a sugar high. It's just propped up by a corporate deadline.
Pretty much.
But, if we look past tomorrow's hangover, there is a much deeper foundational shift happening with the actual rule makers.
Yes, the regulatory side.
Right. We saw that the SEC just issued a staff statement regarding crypto interfaces, platforms like MetaMask, Uniswap, and various portfolio trackers.
A very interesting development.
The signal is subtle, but they are suggesting these interfaces might not need to register as traditional broker-dealers.
Subtle in phrasing, perhaps, but monumental in impact. The SEC is introducing this concept of a neutral tool.
A neutral tool?
Yeah. Which is a drastic departure from the previous regulatory regime.
Mm-hmm.
Under former SEC Chair Gary Gensler, the prevailing enforcement philosophy was incredibly broad.
Oh, yeah. It was a nightmare for builders.
The fear was that if your software touched a crypto transaction in any capacity, even if it just routed a data packet, you were at risk of being classified as an unregistered securities broker.
Which was basically regulation by terror for software developers.
Exactly.
If you built a cool new protocol, you lived in constant fear of a subpoena. But I need to challenge the SEC's new wording here.
Okay.
How exactly are they defining neutral? Because to me, if a platform like MetaMask is processing my transaction and connecting me to a decentralized exchange, they are heavily involved.
You would think so, but...
Where is the SEC drawing the line between a software tool and a financial broker?
So the line is drawn entirely around control and influence. To qualify as a neutral tool under this new framework, the software has to meet very strict mechanical criteria.
Okay, such as?
First, it cannot take custody of user funds. At no point does the software hold your money. You control your own private keys.
Right, not your keys, not your crypto.
Exactly. Second, it cannot solicit trades.
Right.
It cannot send you push notifications suggesting you buy an asset, and it cannot recommend specific token.
Room nudging. Okay.
Right. And third, it cannot guarantee best execution pricing or actively match buyers and sellers like a traditional exchange does.
So it's very passive.
It merely provides the graphical interface for a user to interact with a smart contract on the blockchain.
So it is the difference between a public highway and a private taxi service.
I like that.
The highway is pure neutral infrastructure. It just sits there. You choose to drive on it, you pick your destination, and you bring your own car. If you crash, that's on you.
Right.
But a taxi service or a broker takes your money, puts you in their car, and drives you there themselves. They have a duty of care.
That distinction is exactly what the SEC is finally acknowledging. A tool like Uniswap allows you to swap tokens directly via immutable code.
Okay.
There is no human middleman sitting in an office deciding whether or not to clear your trade. So by signaling that these are merely neutral software tools, the SEC is essentially declaring that writing and publishing open source code is distinct from operating a financial institution.
Which is huge.
It drastically lowers the barrier to entry for builders who previously had to spend, half their seed funding on compliance lawyers before writing a single line of code.
So what does this all mean? We have billions of dollars pouring into the market chasing STRC dividends, and we have the SEC finally giving developers regulatory breathing room to build the future of finance.
It sounds great.
By all accounts, the industry should be throwing a parade. Why then are veteran industry analysts suddenly screaming about ticking time bombs, systemic collapses, and black swan events? It feels like we're looking at two completely different realities.
Well, we are looking at the surface versus the plumbing.
Okay, explain that.
While the surface looks incredibly bullish, analysts like Paul Barron are staring at the structural plumbing of decentralized finance, or DeFi, and seeing catastrophic stress fracture. Barron's argument is that the lack of comprehensive, overarching regulation, specifically the ongoing political delays in passing the Clarity Act, is allowing deeply dangerous behavior to build up in the shadows.
And Barron specifically points the finger at the kind of leverage being used by projects like World Liberty Fi, right?
Yes, precisely.
He's talking about platforms borrowing massive amounts of capital against their own natively issued tokens. Now, for anyone who lived through the crypto crash a few years ago, that specific maneuver sounds terrifyingly familiar.
It is the exact same financial mechanic that brought down FTX and Alameda Research.
Yeah.
Let's walk through how this actually works, because the mechanics of the risk are crucial for you to understand. Imagine a team creates a brand new cryptocurrency out of thin air. Let's call it Token X.
Okay, Token X.
They keep 90% of the supply for themselves and release 10% to the public. If a few people buy that 10% at $1 each, the team can suddenly claim their entire hidden stash of Token X is worth billions of dollars on paper.
Even though that liquidity doesn't actually exist.
Exactly.
Right, it's phantom wealth. If they tried to sell it all at once, the price would instantly drop to zero.
Precisely. But here's where the leverage comes in. They take that artificially inflated, highly illiquid token, and they use it as collateral in DeFi lending protocols.
To do what?
To borrow real, hard assets, like stablecoins pegged to the US dollar.
And
Barron's warning is that without the clear rules the Clarity Act would provide, this phantom leverage is quietly propping up massive segments of the market.
And what happens when the broader market takes a dip? Because in traditional finance, if your collateral drops in value, you get a margin call.
Right.
A broker calls you on the phone, warns you that your account is underwater, and gives you a few days to wire more cash.
In DeFi, there are no margin clerks. There's no grace period. There's only code.
Yes, the code.
When the price of your collateral drops below a specific algorithmically defined threshold, a smart contract mercilessly and automatically liquidates your position.
Wow.
It just sells your collateral on the open market to pay back the loan.
Which dumps massive amounts of that illiquid token onto the market all at once, crashing the price even further.
And that price crash triggers the automatic liquidation of the next protocol.
Oh, geez.
Which dumps more tokens, which triggers the next liquidation. It is an algorithmic death spiral.
That's terrifying.
Barron is arguing that without regulatory clarity enforcing transparency and collateral limits, the entire DeFi ecosystem is essentially a house of cards waiting for a strong gust of wind.
And while Barron is focused on the structural fragility of the system, Benjamin Cowan is looking at the cold, hard mathematics of market cycles.
Right.
And his data provides a very sobering reality check to the current market euphoria.
Cowan bridges the gap between pure data analysis and market psychology. He's looking at the macro charts and concluding that Bitcoin likely already hit its cycle top near $126,000.
Right.
And we have already experienced a 50% drop from that peak.
Yeah.
But what shocks most people is his base case projection.
Yeah, his base case isn't a bounce back to new highs. His expected outcome is a 70% total correction from the top.
Right.
Which would drag Bitcoin all the way down into the $30,000 to $50,000 range.
This raises an important question about how we define risk, because context is everything.
Okay, how so?
If the S&P 500 dropped 70%, it wouldn't just be a recession, it would be a generational economic apocalypse.
Right, we would be looking at the total collapse of the banking system.
Exactly. But Cowan is pointing out that in the context of historical cryptocurrency cycles, a 70% drawdown is entirely normal behavior.
Why is that normal, though? I mean, why does crypto routinely suffer these massive gut-wrenching drops that would just destroy traditional markets?
It goes back to the leverage we were just discussing with Paul Barron, combined with the lack of central intervention.
Right, no Fed to save the day.
In traditional finance, if the stock market goes into free fall, the Federal Reserve steps in, halts trading, acts as a buyer of last resort, and injects liquidity to save the system.
But crypto operates as a pure, brutal free market.
Completely. There are no circuit breakers. When the leverage washes out, it washes out completely to the absolute bottom.
Wow.
Cowan argues that when you factor in the late-stage economic cycle, looming recession indicators, and the geopolitical stress we opened with, the environment is perfectly primed for one of these historical 70% resets.
Here's where it gets really interesting to me. Look at the extreme dichotomy of this market today.
Yeah.
On one hand, you have institutional giants completely ignoring the risk of a global war, throwing billions of dollars into STRC just to squeeze out a 96-cent dividend before a Wednesday deadline.
Total Hyper short-term greed.
Exactly. And on the exact same day, veteran analysts who have survived multiple boom and bust cycles are calmly looking at the data and saying, yes, a violent plunge to $30,000 is likely imminent, and it is completely structurally normal.
It perfectly captures the immaturity and the evolution of the space happening simultaneously.
It really does.
And while all this high-stakes drama is playing out with price action and looming death spirals, the actual day-to-day plumbing of the digital economy is quietly being ripped up and relayed.
And we know exactly what happens when that plumbing is faulty and bad actors are allowed to exploit the system. You just have to look at the recovery efforts announced today for victims of the OneCoin scam.
Right. A tragic example.
The U.S. government has opened a compensation process, offering up roughly $40 million in recovered funds.
Which sounds like a victory for law enforcement until you provide the full context.
Yeah.
The total estimated losses from the OneCoin fraud were $4 billion.
They recovered $40 million out of $4 billion stolen.
Yeah.
It is essentially a rounding error in an ocean of fraud.
It entirely validates Paul Barron's stark warnings. Operating in an environment without comprehensive regulation means that bad actors can create multi-billion-dollar craters in the economy.
And years later, the recovery process yields pennies on the dollar for the victims.
Exactly. It underscores that proper regulatory plumbing isn't just about stifling innovation. It is about preventing absolute financial devastation.
But that plumbing is actively being built right now, and the lines between Wall Street and crypto are blurring so fast, they are almost unrecognizable.
Oh, absolutely.
Look at the intense debate happening in Congress today over interest-bearing stablecoins. Lawmakers are actively fighting over whether crypto firms can offer yield on digital dollars.
Right.
And simultaneously, you have firms like Ondo aggressively pushing the SEC to approve tokenized stock ownership directly on the Ethereum blockchain.
This is the ultimate convergence.
Yeah.
A company like Ondo wanting to put traditional equities on a public blockchain means they want the speed, neutrality, and 24/7 global liquidity of crypto applied to highly regulated Wall Street assets.
If you are wondering why you should care about Ondo pushing tokenized stocks or congressional debates over stablecoins, think about your own bank account or your 401k.
That's a great point.
The battle happening right now will decide if your retirement savings continue to live on a sluggish, centralized brokerage server that closes at 4 p.m. on Fridays.
Right.
Or if they migrate to a global, always-on public blockchain. The very definition of how you interact with your money is being completely rewritten today.
And the ultimate proof that traditional finance views this migration as inevitable is the career trajectory of Chris Giancarlo.
Better known as Crypto Dad.
Yes, the former chairman of the Commodity Futures Trading Commission. He is now going all in on private sector crypto advisory roles.
You do not get much more establishment than a former federal regulator.
No, you don't.
And he's fully crossing the bridge into digital assets to shape policy from the inside.
When the architects who wrote the rules for the old traditional markets leave their posts to help build the new crypto markets, it tells you that the infrastructure we are talking about isn't a speculative fad.
Right.
It is the new foundation of global finance.
So we have covered an incredible amount of ground today on this deep dive.
We really have.
We started with the paradox of strategy and Michael Saylor defying global geopolitical panic by throwing $1 billion at a short-term dividend deadline.
Yep.
We uncovered the SEC quietly changing the rules of the game to allow neutral software tools to flourish without fear of being labeled brokers.
Yep, as a shift.
We navigated the terrifying mechanics of DeFi death spirals and algorithmic liquidations, and we balanced that with Benjamin Cowen's mathematical reality check of a 70% market correction.
With a lot to process.
And finally, we saw how the ghosts of $4 billion scams and the future tokenization of Wall Street are colliding in real time.
It is a massive paradigm shift.
Yeah.
But if we connect this to the bigger picture, it leads to a paradox that I think is the most important takeaway of all.
Oh, okay. Let's hear it.
We talked about the SEC defining interfaces like MetaMask and Uniswap as purely neutral tools, just unfeeling code executing user commands.
Right.
And we talked about Ondo pushing to put traditional stocks and real-world assets onto that exact same blockchain architecture, effectively removing the traditional middlemen.
Right. Disintermediation, cutting out the brokers to increase efficiency.
But if the future of our financial system relies entirely on completely neutral software to trade our tokenized houses, our equities, and our life savings. Well, and there are no traditional brokers or margin clerks left in the middle to manage the risk.
Yeah.
What happens to consumer protection if we all truly become our own banks, interacting with nothing but pure, mathematically unforgiving code? Who do you call when the code breaks?
Wow. That really is the $4 billion OneCoin question, isn't it?
It really is.
When the middleman is gone, there is no customer service hotline to call when you lose everything. You wanted absolute financial freedom, and you got it, but you also inherited all of the risk.
Exactly.
I love that. Keep questioning the headlines, keep looking for the mechanics beneath the price action, and we will catch you on the next deep dive.